A broker is a good place to start because there are just so many policies.
Yeah, so it sounds like every bank has different policies in terms of different kinds of variables, and then you got to pick your customer to fit the right one.
The only customer that we might not win is someone who can fit with an online lender.
There's a couple of things that everyone talk about when we start talking about home loans, and I guess the number one thing is that, hey, how much are you going to borrow, right?
In the non-medical world, to avoid LMI, and that is via what we call a parental guarantee. If you have a family member that has equity in their property, but essentially if mum and dad have a property that has equity and they're happy to give that property to the bank as a second security for the child's purchase, the mortgage insurance isn't required. So they will put 80% of the loan against the kid's property, and then they will put whatever is required.
Remains left on the parents.
Goes, with the both securities.
Hi everyone, this is your host Dr. B, and welcome to another installment of the Investing for Doctors podcast. Today we have Alissa and Elle from Two Birds and One Loan. Welcome to our podcast.
Thank you, Dr. B.
Thanks for having us.
Yeah,
it's
so
great to be here.
Lovely to meet you both. Now, before we start, let's give a personal introduction for each of you. Would you like to start, Alissa?
Yes, thank you. So my name is Alissa Childs. I am co-founder and director of Two Birds, One Loan. We're based in Glenorrey in New South Wales, which is a little rural suburb in northwestern Sydney in the Hills District. 6 years ago, we started this business together off the back of having our first children, and we both worked in a corporate role, and we were just finding the transition a little bit challenging to manage the motherhood and the corporate careers. So we took a bit of a leap of faith. Elle and I were friends from high school, actually. So we just decided to join forces and start the business together. So it's done reasonably well. We've grown it to a team of 7 over the last 6 years. So I'll let Elle take over and tell a bit about her background.
Yeah, so my name is Elouise Dooley, and I am also co-founder of Two Birds, One Loan. So I had a corporate career before transitioning over to Two Birds, One Loan, and it's been a wild ride, but it's been really, really good and very fulfilling. And, we've grown our book largely just through organic growth and through our network over the years. And we're really excited to be working with you. Yeah,
likewise. And Two Birds it's a loan brokering business, is that right? Yeah.
Yes, that's right. So we do all types of loans, but primarily we do residential home loans, but we can also look at commercial asset finance, any types of lending, really. We can point people in the right direction. If we don't do them in-house, we have partners that we can source those out to. But primarily it's residential home loans that we do.
Yeah, beautiful. And I'd like everyone to know that we've joined forces together to actually deliver some services for our medical and dental clients as well. So looking forward to working together.
Yeah, we are too.
We're very excited.
Yeah. All right. So when it comes down to lending and home loans and that sort of thing, I guess the first loan that most people would take, outside of their credit card would be a residential loan.
Yes.
Is that right? So
typically.
Yeah, typically. And, some people choose to get their own home first, and some people choose to invest in a rental property first. But broadly, give us a bit of overview of what the home loan market is like in Australia. What is the how do we typically go about getting a home loan? Because not everyone uses brokers, do they?
No, they don't. So a broker is a good place to start because there are just so many policies and so many differences between what lenders can assist with what, and not every customer is vanilla. We say vanilla, it means, someone that will fit in with every bank. In fact, 9 times out of 10, we have to put a customer with a particular lender based on a policy as opposed to an interest rate. So if you're applying directly with a bank, there's a high possibility that bank is not the right fit for you policy-wise. So they might draw you in with a really cheap interest rate, but at the end of the day, the rate is often not the last thing we look at, but one of the top 3 things we look at, and we almost always have to go for policy reasons as opposed to rate reasons. So that's primarily the reason why you would use a broker. You're not putting all your eggs in one basket of one policy and one bank. So we have access to a huge number of lenders, and we're across all of the policies across all of these lenders. So when someone comes to us with a scenario, when we dig deep on what their circumstances are, we will straight away, because of our knowledge and experience, we'll know which banks will actually look and suit that customer, and then we will go and talk to that lender to get the rates quoted and negotiated down.
So it sounds like there's every bank has different policies in terms of different kinds of variables, and then you got to pick your customer to fit the right one, or even sort of find out which bank or which lender will go slightly different in the requirements.
Yes.
Because the vanilla one is just the cookie cutter.
That's right.
And
vanilla people may not always come to a broker, and often the only customer that we might not win is someone who can fit with an online lender, and they can get their loan approved without any sort of effort and work. Whereas the people we really make a difference to are the people who don't fit inside that square.
Or people with very complex lending structures as well.
Yeah, absolutely. So give me a idea what a vanilla loan looks like. A typical loan. What does that look like, in terms of I'm an employee, I earn X amount of money a year, and I just take that to the bank, and they'll be like, oh yeah, I can lend you this much and get you a place.
Yeah, if there's someone with a strong income and a strong credit file, and they're not borrowing up to their maximum, and they have a good deposit, and there's nothing outside of the square on the salary or the way that they're paid, and they're long term in their jobs, like that would be a typical vanilla client who could probably just walk into anywhere and they'll get a loan approved in one day. So where a broker really, really makes a difference is the people, and there's plenty of them, who don't fit into those categories. So
it's rare to get a vanilla deal. When we get one, we're like, oh, this is a vanilla deal.
And I guess that's also part of the selection bias, right? Because if someone who's like really straightforward, they have a long-term job in a very stable institution, and say a university lecturer that's got a long-term contract, they just go in, this is how much I get paid, this is how much I can borrow, and I just go for it.
Yeah, that's right. But you'd be surprised how many times there are just little things that are outside of the box. So it is surprising, like every scenario is different, and that's what we just love about it, is that every person that calls us has a completely different scenario, often that we haven't seen before. So it's keeps it interesting.
And it might even not be vanilla in terms of their income. It might be the type of property that they're looking at purchasing, because not all lenders will take the same securities. So some lenders don't like high density, some lenders do like high density, some lenders don't like rural, etc. So, even though their income might be fairly straightforward, there might be other factors of their loan application that will not be so straightforward.
Yeah, I recall during a period of time when a lot of high rises were going up in Sydney, some bank lenders wouldn't lend in particular postcodes or buildings because of the high density nature of it. Or and I've heard this before, that if they were overexposed to a particular area, they would say, no, we're not going to lend.
Yeah.
And so having access to a wide range of products or lenders gives you a bit of advantage on picking and choosing.
Yeah. That's right. We very rarely get to a scenario that we can't place somewhere. So there is generally always a lender that will do it.
Might have to pay higher rates.
That's right. And the ones that are a bit more flexible on serviceability and on policy and on income assessments and things, are they're there for a purpose, but you pay a bit of a risk sort of fee on interest rates and fees and things like that. Yeah. But I would say I can't remember the last deal that we've had to say we can't help you. We almost always can help you.
All right, so now talking about, before we get into the semantics and the nitty-gritty about home loans, there's a couple of things that everyone talk about when we start talking about home loans. And I guess the number one thing is that, how much are you going to borrow? Right, that's the first thing. And then the second thing is that what type of property it is. So we'll be looking at, is it owner occupied or is it investment property? Are there any other sort of types of loans outside of that from the residential side, or is this mostly assessed as these two kinds?
Yeah, I mean, to simplify it, yes, it's owner-occ, it's investment. There's, equity releases for different purposes. But in terms of the product options, it's quite limited. Like, it's not very difficult. There's literally, this is when we first started out and we're saying it's literally just an offset product, a basic product and a fixed rate. And that's really... lines of credit generally no longer exist. So they used to be another alternative, but now it's really those three options. So you either take an offset product where you have a separate transactional offset account, a basic loan, which has a redraw facility, which means you put your savings into the loan account itself for the same interest benefit as having an offset, but without it sort of being sitting aside in a separate
bank
transactional bank account. Or there's a fixed rate, which we're not fixing so many people right now, but the fixed market is starting to sort of shake up a little bit at the moment, and we're starting to see them coming back. But going back a couple of years ago when the fixed rates were 2%, we were fixing a lot. 9 times out of 10 people were fixed then. So it was just such a different market. But really, that's your three product options. And when you simplify it down, it's not so overwhelming. But
and I guess the other variables, such as, is this an investment property? Is this an owner occupied? Just affects the rates really, and
it does. And principal and interest, where you're paying the loan off with every repayment, as opposed to interest only, where you're just paying the interest. So we do a mix of those. Some accountants prefer their clients to take an interest only loan where they don't pay it down, and there's lots of different reasons why you would do that, but you pay a premium. And because those interest-only rates are quite a bit higher than principal and interest, if you're doing that for cash flow reasons at the moment, there's actually not a significant difference between the interest-only repayment and the principal and interest repayment.
Really?
Not significant. There is a difference, but back, years and years ago, those
the
two
margin
options,
was very slim.
it was a significant cash flow difference for you to just pay the interest. But because the interest rates are so high on interest-only, it doesn't help. So, that used to help investors to be able to get additional properties, and it wasn't so hard on cash flow. But it's a bit of a different market at the moment for the reason that they do bump up those rates on the interest only facilities.
Okay. Elle, could you go through some of the terminologies that we often use in home loan when we're talking about home loan, right? So we mentioned
so quite often
owner-occupied
that's
investment.
right. That's right.
What other things do we?
So quite often when you're chatting with a broker or chatting with a lender, you'll hear them refer to the term LVR, and this refers to loan to value ratio. So when a lender assesses your deal, they want to know how much as a total percentage of the property value that you're borrowing. So for simple terms, if you're purchasing a property for $1 million and you have a loan of $800,000, your LVR is 80%. And as your LVR decreases, so do your interest rates. So the higher the higher the loan, or the higher the LVR, the higher the interest rate. But look, for doctors, they get lots of special advantages in the market, so they will get better rates than your ordinary person that walks in the door. But for that reason as well, you'll hear lots of doctors talking about, or lots of people in general talking about, cross-collateralising their properties.
Yes.
And one of the major benefits of cross-collateralising your property, so it means you tie up both properties and use them both as security. So you might have one property worth $1 million and another property worth $1 million. So you have both of your properties that are worth $2 million. And then you can quite often get your LVR
of the whole pool.
That's right, of the whole pool of all the loans to be lower, which will result in a better interest rate. So your LVR might drop to 60 or 70%, and the lenders are going to offer you more competitive rates in that scenario.
So in general, with say your LVR is say 90%, 80%, 70%, what's the range of discounts
Oh,
I'm not
It
going to hold you on the
really
actual
varies.
number,
Really
but
varies by
what's the
lender.
general feeling?
Yeah.
It's really case by case. It is like, I mean, a good rate on,
Let's
you know, a
just say-
sub 80 or sub 70 now.
Yeah.
We're getting sort of, I mean, even that's a range at the moment. We had someone yesterday say they could do 5.79 on a variable rate, which we haven't seen in forever.
Oh, wow.
So that up to even a good rate now, we would say 604 is a good rate at
Yeah.
the moment with
Yeah.
with a major bank. And sometimes to get a cheaper rate, we have to play outside of the major bank space. The majors are not typically always the cheapest.
Yes, yes.
But yeah, it's a real range and it's circumstantial. Like for a doctor, a 95% loan would attract a much better rate than a 95% loan for someone in a different
non-doctor.
profession.
Yeah.
Like
And I
significantly
guess
different.
it's a risk-adjusted rate
is.
in the bank.
That's
So
right.
when you're a lower LVR, you're less risky to the bank because if you can't pay, the bank will just take the thing and sell it for a much
That's
larger
right.
amount. And it's much easier to sell
Yes.
rather than if you're at 90%.
That's right. And a doctor, I mean, if we wanted to go into mortgage insurance at this point, which is another term that you probably
Lender's
have
mortgage
heard of.
insurance, LMI.
Yeah.
So that's a term that comes out a lot. And for the the medical viewers out there, that hits anything above 80%, right?
Yes,
That's right.
it does. So yes, anything between 80 and some lenders will do 95% plus mortgage insurance on top. So essentially you're borrowing 98%.
So is that 3%?
Costs a lot.
Yeah.
Yeah, that will cost a lot in interest and the mortgage insurance fee is significant. But a doctor doesn't have to pay mortgage insurance. So with lots of lenders on our panel, we can get 95% on an investment property and an owner-occupied property without mortgage insurance at 80% interest rate. So the saving for the medical world
It's
is
substantial.
significant. Significant.
And dentists as well, I assume.
Yes,
that's right.
Yes.
Yes.
And what are the other professions that sort of
there's
will
all
benefit from it? I
sorts,
think
yeah.
accountants and
Accountants and lawyers,
Yeah.
they generally get up to 90%.
Yep.
Doctors and dentists, they will get
Vets.
95%. Vets will get 95%.
But they even, a lot of them will do allied health now. So we can get 90%
so
LMI.
professionals.
Medical professionals,
Yeah.
typically medical,
Yeah,
yes,
yeah.
but some professions outside of the medical field. But yeah, they are opening it up to like radiologists and midwives and registered nurses and things like that. So
Good.
yeah, there is lots available to even allied health
Allied health.
physios,
Yeah.
podiatrists.
No, I think a lot of our nursing colleagues will love to hear that because housing affordability is an issue, and if you can get 90% without paying LMI, that's a
Yes.
huge.
It's such a saving.
It is. It's a huge saving.
It's such a huge saving.
Yeah,
Right,
and
okay.
particularly for first home buyers, when you factor in the stamp duty waiver and the
Yeah.
LMI waiver, it makes a significant
That
difference.
could save sort of 50, in some cases more, but just for as a first home buyer alone, to not pay LMI and not pay stamp duty up to 800,000, no stamp
850,
duty,
yeah.
then it could save you like $50,000 to get
Yeah,
It's a huge leg up.
50,000 less deposit you have to have.
That's
That's
right.
right.
Yeah.
Which is significant.
Oh, very significant. I mean, I think back in my younger days, if we had access to that, it would have
Yeah,
been significantly cheaper
that's right.
to buy these things. So great. So the next, we talked about LMI. What actually is LMI? Because we talk about it as an insurance, but it's not really insurance for us, is it? It's
It's not like
insurance for the
that
bank.
Yeah. So lender's mortgage insurance is a policy that the bank takes out by a third party. So, generally they're quoted up by, Helia or I don't know who's another one, QBE or something like that. So LMI is a sliding scale based on how high or low your LVR is, and then also based on your property purchase price. So for most lenders, they will outsource this to a third party, but for some of the lenders, they will self-insure. So they've got their own insurance products within their lender. And it's basically an insurance policy that
we
in the
take
case
out
that, yeah, that's
the
right.
bank.
That's right.
Yes.
That in the case that you default, the bank is covered because there isn't enough equity. There isn't that 20% equity buffer to cover the lender in the case that you default on the loan.
So if you don't pay your loan and the bank has to sell your property and they sell it for less than it's worth,
Yeah.
the insurer will cover the difference for the bank. So the customer pays a premium to cover the bank
Yeah.
for having
Yeah.
a short deposit. Yeah.
Yes. And I mean, when it's quoted at 3%, that's actually quite significant, isn't it?
Oh, the costs of
Yeah, the
mortgage
cost.
insurance
Yeah.
is very high.
Yeah.
I mean, I've seen
really-
premiums as high as $45,000, $50,000
Yeah.
on top of.
If it's $1 million purchase at 95%,
Yeah.
it's huge.
Very significant. But then, if you're only at, 85% and you're purchasing for 900,000 or whatever it is, the premiums, are a lot less. They might only be between 5,000 and 10,000.
It's a risk
Okay, so
So it's a sliding
percentage
scale.
It's a sliding scale
Yeah.
of that, and the higher your LVR, the more it is.
higher your purchase
Yes.
price and
Yeah,
the higher
yeah.
the LVR,
Yeah,
the higher
yeah.
the premium.
Yes. Understand. So it sounds like the LMI waivers is a really good mechanism. Yeah.
Yes.
It's such a
It's
huge
such- yeah.
value add, yeah.
Absolutely.
And there's other ways for people in the non-medical world to avoid LMI, and that is via what we call a parental guarantee. So if you have a family member that has equity in their property, and there's terms and conditions and policy requirements and things, but essentially if mum and dad have a property that has equity and they're happy to give that property to the bank as a second security for the child's purchase or their
Yeah.
kid's purchase, the mortgage insurance isn't required. So they will put 80% of the loan against the kid's property, and then they will put whatever is required
Remains left on the parents.
goes with the both securities.
Oh, right.
So they'll take dual. So it's a limited guarantee for the parent. They're just guaranteeing up to 25%.
Yes.
In these cases, you can actually borrow 105% of your purchase price. So you
Okay.
can go into it with no deposit.
Right.
Yeah.
Right. So if I was a well-to-do well-to-do family, I could literally borrow the whole
Yeah.
cost of
Yeah.
it, provided I have parents
A
who
parent
have
that
something
has a
that has
property.
happy to do that.
Yes.
And
yeah.
it's particularly useful in instances whereby you might have been on a conservative income for many years and you haven't had the means to save a big deposit or any deposit at all. And then all of a sudden you come into some money, your income has increased quite significantly. You can now afford to get a loan, but you just don't have the deposit to get in the door.
Well, I think for some of our medical colleagues, because we spend so much time at university,
That's right.
we might come out with a paycheck, but we've just spent the last 6 years or sometimes 8 years at university,
Yeah.
and we obviously haven't saved up a deposit. And if mom and dad can come and help, that would be a
That's
Yeah.
right.
situation
That's
with
another
all the
way.
dangers of getting mom and dad to help, of course.
That's right.
Yeah.
I mean,
Yeah,
look, they
yeah,
do
yeah.
have to get independent legal advice and all of
Yeah,
that sort of thing.
yeah.
So there are lots of check boxes that, we do
To
have to go
protect
through the
the
motions to
parents.
protect them.
Yeah.
And, in those instances, we meet with the parents as well, make
Yeah.
sure that we're not putting them into any sort of, financial risk.
Yes.
So there's lots of due diligence that happens before.
And that's where a broker obviously
That's right.
comes
Yeah.
very handy, because
Yeah.
you're not going to walk in a bank and say, hey, I'm going to borrow 105%.
That's
Here's
right.
my parents.
Yeah.
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 And a lot of people in the generation of the parents are not so digitally savvy, and
Yes.
they're a bit unsure, and they might not have had a mortgage for a number of years. So it's quite a sensitive process, and we often, there's a lot of hand holding from our team for the guarantors through that time to make sure that they know exactly what they're doing.
And in those situations, does the mortgage on the parents' property have to be a first mortgage, or can it be a second mortgage?
You can do either.
Yeah.
Ideally,
More complications.
It's,
Yeah.
just,
Second,
it's
yeah.
a more complex
Yeah.
Just adds another step.
scenario. But yes, there are some lenders who will take a second mortgage behind another bank, depending on the low LVR and that sort of thing. But ideally, you'd want the parents to be either unencumbered on their own or occupied, still working, or have an investment property they can put up that's not going to affect their owner occupied. But ideally, at the end of the day, we need to protect them and make sure if something goes pear-shaped, they have an exit strategy.
You still have parents to go back to.
Not have to sell their home. So
Yes.
And I think
We
the
are
idea
quite-
is as well that, we will release the guarantee as quickly as we can.
Yeah, once it goes below.
So
a certain-
every year we check in, we have a look at, their loan balance, and then we have a look at the value of their property. And then looking at a combination of, the capital gain and their loan balance. As soon as that hits 80% of their property value, we can then
release the
release the
parents.
guarantee and
Yeah,
set them on their way.
So the idea is there's no...
It's short
It's
term.
not. It doesn't implicate the parents
Yeah.
really. Ideally, they won't even know it's happening, and they've just saved their child
lots and lots of money.
Lots of money.
So I mean,
Yeah.
I see this as a mechanism for parents to assist without actually giving money
Yes,
to
that's
their
right.
kids.
That's right.
Because
That's
what we do sometimes see is that, you go to the bank of mom and dad
Get
and then
cash deposit.
you get some cash from parents, and then legally is that the question is, okay, is this a gift? Is this a loan?
I know,
and if
that's
it's a
another
loan, how
topic.
would the banks view that and that sort of thing? Because often those are not declared.
That's right.
Yeah.
And there are lenders that will take parents that, might be retired or not earning much money, but they have a big house with lots of equity. So they don't even necessarily need to be working in all instances. And again, all the lenders have different policies on guarantors.
Yes.
And we just steer them in the right
Knowing
direction.
which one is the right one.
Well, I think the key for these is to remember that the borrower has to service the whole thing.
Yes.
So the income serviceability will always lie with the borrower.
Yes.
Yeah.
I mean, it just sounds like it's structured very differently, and you're still borrowing the full amount.
You are.
but
That's
then,
right.
You're not relying on a cash gift or
Yes.
loan from.
So
the
if serviceability is not there,
parents.
then the cash deposit would help that person because that obviously reduces the amount of lending that we have to take out. And yes, there are ways to protect parents if they're giving a $300,000-$400,000 loan or gift to to their child. We just always recommend they go and see a solicitor and have a private agreement drawn up around that, because a lot of the lenders will request that the parents state that it is non-repayable. And sometimes
otherwise it's another loan,
that's
right?
right, which has
Liability.
to be factored into serviceability. But there are ways around that, and there's wording to get around that where we can get the parents comfortable, get the lawyer's tick of approval, and the bank's comfortable that say it's only repayable on sale of the property, for example. So if the child goes into a relationship and they separate, then that
that's
gift,
one of the reasons for the gift.
goes back to the parents
Yes.
before the equity is split with the partner. So it just protects that. It's an early inheritance, essentially, is what we say it is. But we're very cautious around making sure that's all sort of legally set up in the background to protect that money from any sort of future partners and things, which is usually the biggest fear of.
We might dig into this rabbit hole a little bit deeper now because we're at this. You technically and a partner legally after 6 months residing together. Isn't
Yes.
it?
Right.
Yeah.
Yeah.
So in these situations, it could be a live-in partner or girlfriend, and they could be exposing yourself to a large sum of parental gift if
Yes,
you don't
that's
have
right.
if you don't have agreement. in
Yes.
place.
So we always recommend to talk to a solicitor and get a formal agreement drawn up around conditions of that gift or.
Yeah, I'm sure you guys would have seen some interesting stories.
We've never seen anything go bad. Everyone that
No,
we
really?
No, we haven't.
look,
Like
none of
everyone
our
protects
clients.
themselves.
Yeah.
Not our clients, but no, everyone that has had the family gift has protected themselves.
I've
with,
heard it happen through
them.
friends, but not through clients.
have you?
I mean, in the industry, right? You would have heard some.
It would
really,
happen.
Yeah,
I've
it
heard
does
a couple
happen.
of nasty stories from
Yeah.
my colleagues
Yeah.
as well. In the medical profession, sometimes relationships don't last as long because
Absolutely.
we're busy people.
Yes.
So now now that we mentioned about serviceability is also another term that comes up a lot. And what does that mean?
So serviceability refers to your ability to repay said home loan. And serviceability depends on a few factors, mainly your income, how much you earn, whether that be through a PAYG role, so when you're employed by somebody else, whether you're a sole trader or whether you're a company. You can derive your income from any one of those sources. And then it also depends on your liabilities. So how many credit cards you've got. And you would be surprised how many clients we see once we check their credit files. They don't know that they've got, $50,000 worth of credit card limits. And those credit card limits are then expensed against your living expenses, which then decreases your ability to service the loan. So part of our role when we first meet with someone is to go through all of your income, all of your assets, all of your liabilities, and particularly the liabilities, because then we can see what we can cancel, what needs to stay in place, what needs to be paid out, and for lots of people, they've got HECS debts and things like that, which also affect their ability to service the loan. When we talk about serviceability, it's your ability to repay the loan and how much of the loan you can afford.
Yeah. And it's not on a dollar for dollar value, isn't it? There's
heavy buffers built into it.
Yeah,
so
tell us some of that.
At the moment, with most of the lenders, there's a 3% buffer built into the interest rate. So if your rate's 6%, they will assess you as though it's 9%, and that's regulated through ASIC. Even though we're at the peak, they say, of the interest rate market, there is no, there's been some whispers, will they reduce that buffer? Because it's quite a big buffer.
It's 9%, to pay off a 9% loan is quite rough.
It is, yeah. But I think given how volatile the market has been over the last couple of years, I don't think they'll be making any changes to that. In saying that, we do have some lenders who are non-bank lenders who are not subject to the regulation that the banks are subject to, who have a 2% buffer. So we do use those lenders really mainly in cases where someone says, I absolutely need to go to my maximum, and they're comfortable too, and it services for them too. We would go to these lenders who have a 2% buffer. So there are lenders there with a smaller buffer.
Yeah. I mean, the irony of it is that when interest rates were at 2%, the 3% buffer wasn't enough for the current climate.
Took us to 4.95. I remember was the buffered rate, the lowest buffered rate we had. Yeah. And all of those clients are now paying over 6%.
Above their technical serviceability.
Yeah, that's right.
So
above. So lots of people in a lot of pain.
Yeah, exactly. Yeah. And so that's one of the buffers that we talk about. But there's also, buffers or on your earning from investment properties as well, right? So that's another one that I hear gets discounted a lot.
Yeah, that's right. So when the lenders look at your income, so they'll also, obviously they'll look at your income that you earn from your job, but then they'll also look at the income that you earn from your investment properties. And then there's also other factors that they need to associate, such as your any sort of fees, maintenance fees, costs, costs to maintain your investment property. And then the lenders may also buffer your income from the investment properties by anywhere from 10 to 20%, depending on which lender it is. And, given all the issues that we've had with serviceability over the last sort of year or two, since interest rates have, increased quite significantly, the lenders are looking for new ways to increase people's serviceability. And some of these ways have been to decrease the buffer on the rental income. So we've seen many lenders go from, 70 or 80% down to sort of a 10 or a 20% buffer. And likewise with living expenses. So which is something else I didn't touch on before. So when they're assessing your serviceability, they'll also look at your living expenses. And the lenders will, they have an indication of what living expenses look like for, a family with, 2 income earners with 2 children of a certain age. And they will apply what they call HEM, which is household expenditure measure. And for, if your living expenses are extremely low, they will apply HEM. So it's a benchmark living expense.
Oh, right. So it's a bottom.
It's a bottom line.
Yeah.
So, for a family of, 4 people, they might say your benchmark living expenses are $4,500 a year.
A month.
A month. My gosh, impossible. So $4,500 a month. Yes. And then there's a few other expenses that come in over HEM, so such as your private health. Recently they've actually included strata fees into your HEM. It used to sit on top of HEM. So this is another sort of measure that they're using to help serviceability. So originally they, if you lived in a unit, they would use, baseline living expenses, and then they would add your strata on top of that.
Yes.
But now they're including that. So it's freeing up a little bit of capacity. So they're always tweaking in the background, and quite often the lender calculators change from time to time, and we're like, what's changed? What's going on? And they're always making tweaks. And it may not be that serviceability buffer, but it may be how they assess, external liabilities or how the living expenses are assessed or that sort of thing. So they are looking for ways for people to, be able to purchase, but it may not be the buffer that changes.
Yeah, right. Okay, that's very interesting how that changes.
They tweak things and they don't tell us what.
Yeah. And if say you lived a slightly more lavish lifestyle and you were expensing above that, do they take the more lavish lifestyle as that calculation?
Yeah. So we do our own assessment of living expenses. And it's very thorough and detailed. It sort of pulls it into a spreadsheet for us using some software that we have and categorizes all the different categories. And the two main categories that people overspend in are recreation, entertainment, clothing, retail, that sort of thing.
Yeah.
So honestly, what a typical scenario, like maybe not in medical space, because I think so many doctors work so hard that their living expenses are actually quite low comparative to their incomes. But a typical first home buyer who's never had a mortgage before and might have $100,000 or $200,000 of household income might be spending $4,000 a month just on going out. And we would have the conversation, say, this is what you're spending, and most of them are shocked and surprised. Most people spend more than what they realise they spend. But we just have to say, look, going forward, this is what we would recommend you budget yourself to. And it might be $2,000 a month as opposed to $3,000 or $4,000. But we just work with the borrower on that and what they're comfortable with. And some people say, I don't want to give up my lavish lifestyle. I want to be able to have a buffer of X, Y, Z. So we just, the discretionary categories we can negotiate with them on. Yeah. And there are many categories that we can't. Like we can't negotiate on insurances and we can't negotiate on strata and rates and that sort of thing. So discretionary, it's a bit of a grey area. And it really is subject to a lot of conversations to say, what do you want going forward once you take this loan out? Because we don't want to put someone into a loan where they can no longer go out for dinner a couple of times a week if that's what makes them happy. So it is, there's lots of work that goes into the analysis.
So there's a lot of tweakage that you can do.
In those categories really only,
And let's go back to this other thing which comes up a lot, credit cards. Right, because I have a number of colleagues who like to churn credit cards and they go through a few a year to get points for flights and that sort of thing. So how are credit cards assessed that? Are they assessed at your lending cap, or you assess that how much you use, how much interest you pay? How does that work?
So quite often we'll get, a lot of people that come to us and they're like, oh, we've got, $30,000 worth of credit card limits spread across, 3 cards or whatever it is. They're like, look, we pay them off every single month. We're really good with them. You don't need to worry about them. And I'm like, oh, I wish I could not worry about them. But the lenders have another view on that. And essentially you can max those credit cards out at any time and you will be liable to pay them off. So in the lender's eyes, they are a $30,000 liability. And the minimum repayment on those credit cards is about 3.8% of your total limit. So, for example...
that's not very high.
But when you add it to your living expenses and you're looking to maximise your borrowing capacity, that could be the difference of, 50... In some instances, we've found it's a difference of $100,000 in borrowing capacity just by cancelling some of those credit cards.
Cancelling them,
That's right, or bringing them back down so you've just got one $10,000 credit card because, people do... credit cards have great perks and if you can maintain them effectively, they can be a really great tool for accumulating points and, shopping dollars and all the rest of it. All the benefits that come with the credit cards.
So they're not being assessed at, say, if you have $30,000 limit and, you have that much
interest rate.
20% interest on that. They're not being assessed at that.
No.
Well, that's helpful.
Is it 3.8% per annum, I think, is what they mostly use.
Okay, so
I
single
think
digit.
they just work off the minimum repayment. So if you're going to max out that credit card and you need to make a minimum repayment on it every month, that's the minimum repayment to keep the credit card.
Okay. So
long story short, it does make a big difference to capacity. It really does. So we often have to tell people to reduce the limits.
Yes.
Some people, especially from the older generations, just can't fathom why. Like
they say, I've
had a credit card my whole life, and you're telling me, and I've never defaulted, and I pay it off every month, and you're telling me they won't let me have a $5,000 credit card to take this mortgage out. I'm like, that's what I'm telling you.
Yeah.
Like
Yeah.
there's no negotiation.
It's nothing personal.
It is like, if you want this loan amount, you have to shut that limit down.
Yeah, and so this is very interesting because in the a lot of doctors actually have a Amex charge card.
Yes.
And
Yes.
my understanding is that doesn't calculate in it at all.
No, when there's no limit,
Yeah.
they tell us to just factor the spending into the expense analysis.
Yeah. Okay.
So yes, that's one way around it.
Yeah, well,
Is to
because
get
you
it-
got to pay off it at the end.
You
of
do,
the month.
that's
do.
right. So they're
you
a bit
can't-
different.
It's a bit of a grey area, the old charge card. Like I feel like lenders look
Well,
at
it's
them a
not
bit
got a
differently.
limit.
Yeah.
So, yeah.
Yeah, I mean, what I've been told is that there's not much you can do with that. It doesn't even come
No.
up on credit ratings. Apparently.
Yeah.
So,
Yeah.
so that's an interesting one. Yeah. So it sounds like there's obviously lots and lots of different variables, and it's not that straightforward as most people think. It's just like,
It's
I earn
not.
X amount of money. I can borrow up to 5 times my wage or something like that. And,
No, there's lots of factors.
So many
Yeah.
factors. And there's so many. I mean, the good thing is there's lots of levers to pull. And I think, people might think it's sort of a straightforward transaction of this is my income, this is what I want to borrow. But then when we get into the nitty gritty of it, there's lots of things that we're like, okay, can you pull back on this? Can you cancel that? Can we have a look at, what's your income if you're a company or a sole trader? What does your income look like for FY24 if you've only done your 23s? I mean, that's self-employed. It's probably another can of worms.
That's probably another
yeah,
conversation.
yeah, we're just trying to touch the
but
simple
look,
stuff today.
There
Yeah.
are lots of triggers that you can pull to get you to the capacity to where you need to be, whether that be through income, whether that be through a lender with a smaller buffer, whether that be through cancelling liabilities.
Or
whatever it may be.
consolidation
Yes.
is another thing we will do. So, of course, if you have a car loan and it's $1,000 a month, or a novated lease, which we see a lot, which novated leases significantly, brutally crush serviceability.
I'll do that.
They
yeah.
do, because it's sort of double dipping, because the whole cost of running a car is deducted from your salary. So your net salary, sometimes the biggest payment I've seen on one of these was like $4,000 a month for a novated lease off the salary. So you don't even see that money.
Yeah. So when they're assessed,
So then we
they're
assess the
assessed
living
at a lower-
expenses,
Yeah.
and there's a benchmark inclusive of transport, but transport's covered by the novated lease, but we still have
so
the
you
benchmark.
get doubly negatively
So
affected.
there's the novated lease. Losing all of that income just to pay for a car, it's like usually double what it would be if you just had a normal car loan.
Yeah. So it's taken. So the banks assess it as if you're not getting that earning, and then at the other time, because of the HEMS benchmark,
The transport that is factored
that is
into
always
HEM.
factored in regardless of what
Yeah.
the situation is. So you get hit on the reduced earning and also on the on
That's
the
right.
cost.
Yeah,
That's right.
Oh, wow, okay,
and they're
that's-
just very expensive. I mean, there's obviously some tax benefits there, but it's quite an expensive way to buy a car. But yeah, you can consolidate them, and we've done that before. So where it's affected capacity so much, and you can consolidate a car loan or a personal loan, and that obviously your repayment on those over 30 years, and we have some strategies to make sure they don't pay those off over 30 years. We keep
Yes.
the separate split for them. But that's another way to improve capacity. There's just lots of ways, and we usually would assess you and say, this is your capacity, but if you do this, we can get it to this. If you do this, we can get it to this, and we give them options to find ways to increase it if they need to.
Wow, awesome. Look, I think we've touched on quite a number of sort of, I guess, there's still relatively basic things, but like I'm already learning a number of things which I didn't realize existed. And so I guess in one of our next sessions, we'll talk about sort of deeper topics like structuring and what do you do if you're a sole trader? What do you do if you're not a employee? Because so far we talked as if everyone's an employee.
Yeah,
That's right.
Yeah.
The self-employed world of income assessment is from like here to the next suburb, like the ways we can assess them.
Yeah.
So yeah, it's not every bank has a multitude of different options to assess someone who's self-employed. And when we enter the medical space, the policy rules change again, and they're so flexible. And I think a lot of doctors probably don't realise how flexible the lenders can be when assessing income, short-term ABN income, overtime, all of that sort of thing. They're very, very flexible because it's low-risk transactions. So yes, that's probably a whole nother conversation.
Yeah. So thank you for your time in this session, and we look forward to having you back on future episode.
Thank you.
Thank you. Thanks for having us, Bi.
Yeah. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.